Let's look at the macro level first. We've heard all day about the G7 finance chiefs talking about the Eurozone. Apparently, I heard one report saying that they'd agreed to work together, which is wonderful to hear, but it doesn't tell us very much. What are the markets waiting for here? And I mean, the markets do need some direction.
I think the market's looking for some kind of firewall to be put up either around Greece or Spain as well. I mean, I think Spain is really the sort of the linchpin in the sort of whole equation at the moment. It is very large relative to Greece, Ireland and Portugal, in fact double the size of those three countries combined. So it'll actually be quite difficult for the Eurozone to actually step in and save them. So people are looking for some kind of firewall to be put around their banking system and hopefully the ECB to actually lend directly to those troubled banks. Now
we saw a report today also that Spain has now admitted it needs outside help. The funding of its banks is now apparently doubling by the week.
Well, yeah, I mean, you have a situation where you run into sort of some kind of a contagion impact. I mean, South Africans are quite used to having rates, anywhere from sort of 6 to sort of 16%. But these European countries have been operating in an environment where, rates have been sort of 4 or 5% at the most. And Spain now is, every time the government goes out to auction to issue more bonds, they're paying more and more, and now they're paying sort of almost sort of 6-7%, which is the level where sort of Greece, Ireland, and Portugal actually asked for bailout. So they're finding themselves sort of increasingly difficult to try and fund themselves. And then the banks, on the other hand, there's very few investors or depositors who want to keep their money in Spanish banks. So the bank's obviously facing a funding crisis as well.
Well, I was talking earlier to Ian Cruikshanks, and he was saying how, we were saying it's almost the opposite of a failure of a bank in the sense that it hasn't got any money. It's got money, but it's stuck. It can't lend it. Everything sort of seizes up.
Well, I mean, a bank is a sort of a massive sort of leveraged animal. There's lots of assets on its balance sheet, and then liabilities. The liabilities sort of tend to be deposits, and people can withdraw those on a daily basis. But on the asset side of the balance sheet, the Spanish banks are heavy into real estate. And obviously they've suffered massive losses on their real estate portfolio. So it's a very illiquid portfolio, and obviously they can't realize it to fund the deposits, and obviously they leverage as well.
Another report today, Goldman Sachs is saying it's worried that the euro crisis could spark a bear market in the US. Now there's no sign of a bear market there, and we were saying earlier also that it's a more fluid economy, it's a more flexible economy, it can shed jobs and take jobs on better. Is a bear market looming because of Europe?
Well, I thought we've been in a bear market for the last 4 years. I mean, the market peaked in 2007. We're sitting in 2012. You've made no money in US equities in the last sort of 4 or 5 years. We keep talking about whether we're in a bear market. I mean, you've made no money. So in a sense, I think we are in an era of contracting profits, and that's because the developed world is over-leveraged, and we have to go through a period of deleveraging.
Let's look at the local market and the interesting comment by Sanyati, the construction company. I'm not sure what precedents there are for this in South Africa, where you have government contracts and they've actually asked to be put under administration, business rescue and so on. Bills of 43 million, 20 million, 30 million from provincial governments for roads built have not been paid. And they say they've met with the officials, but no bills have been paid, and they actually now are in trouble as a company.
What we find when we speak to different companies, there seems to be pockets of excellence in government, and also particular provinces are much better at paying. But there are sort of certain departments that are very bad payers, and companies will then obviously complain about work being completed and then just simply not getting paid. I mean, this is obviously a sort of an extreme situation where you effectively forced a company into business rescue, and jobs will actually be lost.
And the disturbing thing, that's a listed company, so of course we hear about it, but we don't know how many other smaller companies and smaller suppliers are perhaps in the same problem. But it does raise questions about investment perceptions, doesn't it? Because government bonds, for example, used to be regarded as fail-safe, and government contracts. Private companies love to get government contracts because it's assured spending. Not the case anymore, which raises questions about private investment in public-private partnerships.
Yeah, I mean, we have to sort of distinguish between the ability of government to pay and sort of the capability of them to pay. So they are able to pay. Our government is different from a lot of the European countries. We do have the cash in the bank. It's just the sort of administrative capability of the government is very weak. And at some point, and we've seen sort of government trying to centralize a lot more at the central government level, given that the provinces or the municipalities simply don't have the capability to pay.
Let's look at the sectors. We've just been going through them now, and it's interesting to see oil staying below $100. We're seeing gold around about 1634, and Judy was talking about it going to 1650 perhaps. What's your sense of where the commodities are at the moment in this volatile global environment?
We like the precious metals. I mean, we think that will be an alternative currency or store of value. You've got the 2-year German Bund almost at zero or negative rates. So, the attractiveness now of putting your money into something like a platinum or gold where you're getting no return is identical to government bonds. And we think in a world of low real interest rates, the precious metals will do sort of exceedingly well. We would be concerned about current commodities that are too exposed to the growth engine of India and China. So we think iron ore probably has some sort of downside correction. And we saw the CEO of Fortescue coming out this morning, I think, arguing that there could be a correction in that commodity. Oil, I think there is a much wider demand base, not just exposed to China, but I think that had a bit of a premium or war premium built into it post the Mubarak sort of Egyptian uprising last year, and I think it's lost that premium. And hopefully from here it finds sort of better support.
Of course, there's the equation between the rand, where the weaker at the moment, and the oil price. But then, of course, manufacturers and miners are also looking at the weakening rand. So in terms of those sectors, would we be looking at not a perpetually weakening, but a strongly a weakening rand in the sense that it's a trend that continues, and manufacturers and miners start looking like good places to be?
Look, the rand has moved quite a lot. I mean, it was sort of, in the sevens, low sevens this time last year, and we've moved, as you said earlier, sort of to 860, and now it's settled around 840. I think the rand has moved, and it will give a lot of manufacturers some kind of breathing space. But to build your business model on the case that the rand will sort of depreciate here much further from here, I wouldn't necessarily think that is true.
The banks, our banks, it's a sector which we are very proud of how it's regulated, and they are stable and all that. Extra capital requirements coming, but also perceived to be good investments compared to banks elsewhere.
Yeah, I think relative to banks elsewhere, our banks are sort of very well capitalized. Our sort of core tier 1 ratios are sort of north of 10%. Most Europeans sort of struggling to hold on to around 5%. There is obviously a dynamic between a bank being sort of too safe and what return it can sort of generate for its shareholders.
It has to take risks.
Correct. And some investors often look at our banks, and although they're very safe, might not actually generate a very good return on their equity. So if we look at Nedbank, ABSA, their ROEs in their last reported period were sort of very low teens, and you would really want them to try and generate much higher returns, similar to what sort of the manufacturing industry is generating in the 20s. But that would either require stronger advances growth, i.e. a stronger economy, which we don't really necessarily see, or them returning some of this excess capital to shareholders.
We heard Willie Oosthuizen earlier talking from the ICT in Durban and Cape Town, and we've been talking a lot about telcom, the 8% share drop on Friday, and it must have been a surprise to investors and indeed to telcom executives that the government refused to approve this deal, which presumably they'd been apprised of along the way. There were several cautionary announcements since October, so it can't have been that they were surprised by it.
Yeah, well, we're quite disappointed with the announcement. Obviously, government does have its reasons.
Well, we'd like to know what they are.
Correct. And if it's a matter of price, we don't necessarily totally agree with that. Telkom is a listed vehicle, so presumably all shareholders should have sight of what the price is, and we can all then vote on the transaction. And government has its 39.8% share, and the PRC has their share, and institutional investors would have their share as well. Now, the risk is obviously now KT walks away, and we have a rights issue, which might then be at a lower price to what KT was going to offer. So you need to sort of balance those two arguments.
That 40% shareholding is neither one thing nor the other, is it? It's a big negative influence if they want to block things, but on the other hand, they can't run it like an open state-owned entity.
It's negative control, essentially. They have the final say, and most sort of company resolutions would require 75% approval. So effectively, they have what would be termed sort of negative control. They used to have a golden share in Telkom when it first listed, which gave them the right to appoint sort of certain board members. And just before their golden share was going to expire, they did sort of pack the board quite full with sort of government representatives. So you do sort of have a listed vehicle, but sort of part sort of SOE, given sort of government's big involvement in that. And there's obviously a strategic rationale why they want to have some say on how Telkom is run, but sometimes they do also need to think that there are other shareholders involved in this entity, and ultimately it should be run for the profitability of the company.